Hello, I'm Paul Beard, Chairman of the Alexander Beard Group, an international financial advisory business that I founded over 25 years ago. I'd like to introduce you to AMVEST, our new product for Brits in the USA who have left pension funds back in the UK. Please take a moment to watch the following presentation. It provides information on how we can manage your UK pension fund from the USA and provide you with US dollar denominated benefits. This short piece also introduces you to my colleague, Guy Baker, the Managing Director of Alexander Beard USA. Guy explains the ethos behind the investment strategies we use in AMVEST. I hope that you find a benefit from watching, and if you have any further questions, please don't hesitate to contact us.
Introducing AMVEST. In April 2006, in response to the large number of UK citizens settling permanently overseas for their retirement, UK Revenue and Customs outlined new rules for qualifying recognised overseas pension schemes, QROPs. This has allowed many millions of pounds of UK pension funds to be transferred to British people living permanently in countries such as Australia, New Zealand, Canada and South Africa, giving them convenient, cost-effective and tax-efficient access to their pension benefits. Even British citizens living in locations that have no pensions infrastructure have been able to benefit from this system by using offshore QROPs based in the Channel Islands, Isle of Man and Malta. However, in the United States of America, the authorities have always refused to allow incoming pension transfers. For British people living in the USA who intend to settle there and make it their permanent home, this inability to transfer UK pension funds has become a growing frustration. Fortunately, the expert team at Alexander Beard has worked long and hard to address this complex issue, and we are now delighted to introduce AMVEST, the ultimate pension solution for UK expatriates living in the USA. How you will benefit from AMVEST. Your pension remains under UK rules. Your pension funds are invested in US dollars. You have access to investment advice from a USA-based registered investment advisor. Your investment is managed by one of America's leading fund managers. Low annual management charges. You have access to your account online 24/7. You can take 25% of your fund as tax-free cash from age 55. Your benefits are paid in US dollars from age 55. US dollar annuity purchase. Existing clients will have no transfer charges when you move to AMVEST. It is our understanding that the UK-USA tax treaty specifically protects the tax-free nature of pension cash lump sums. However, we cannot guarantee that individual IRS officers will agree with this interpretation. Frequently asked questions. When considering the launch of this product, we had a number of considerations. The only alternatives are to either remain in your present UK arrangement or choose an offshore, USA-friendly QROPs product in the Channel Islands, Isle of Man or Malta. However, the latter may include significant risks and costs as discussed below. AMVEST remains under UK rules, so should QROPs transfers to the USA, such as an IRA or 401k, become available at any point in the future, you will still be able to transfer. We believe that the tax-free cash lump sum and income paid under a UK SIPP are as good as the potential benefits of an IRA or a 401k, so a QROPs transfer to these products may not be in your interests, even when they do become available. These arrangements may offer a slightly enhanced tax-free cash lump sum. For example, you can take 30% as a tax-free lump sum in the Isle of Man. However, since neither the Channel Islands nor the Isle of Man have a tax treaty with the USA, it is possible that the USA authorities would treat such arrangements as a passive foreign investment company, PFIC investment, and your lump sum would then be taxed by the IRS. Malta does have a tax treaty with the USA, and a small number of USA-friendly QROPs plans have been launched on the back of this. Nonetheless, AMVEST, with no set-up charge for existing clients, an annual trustee charge of less than £500 per annum, and low annual fund management charges, still represents much better value for money. Unlike a QROPS plan, where you have to deal with an offshore agent thousands of miles away, AMVEST gives you access to the services of an authorised and registered investment advisor in the United States. AMVEST charges. There is a one-off setup fee for new clients of 1% with a minimum charge of £1,000. No SIP setup fee but an annual charge of £495. Annual advisor and fund management charges not exceeding 1.53% per annum. Benefits payable from AMVEST. Tax-free cash payment of 25% of the fund payable from age 55. Please note that no new contributions into the plan are possible at this point. Income can be paid immediately or taken in whole or part any time from age 55 to 75. Income payments may be subject to tax in the USA. However, the UK-USA tax treaty allows for any UK tax deducted at source to be offset against any USA liability. Application may be made to HMRC in the UK for gross payment without deduction of UK tax.
My name is Guy Baker, and I'm the host for this program on What Happened to My Money? It's on managing markets, not stocks. And so this is the first in a series of short videos that we've created intended to increase your knowledge about equities and why they behave the way they do, and what you can do to protect yourself in volatile markets. Let's go back a little bit. The year 2000. You may remember things were flying high. Nothing could harm your plans for retirement. You were almost there. Tech stocks were on the way up. Optimism was high. Just a few more years and you could escape the daily grind. Your portfolio would make you financially independent. Remember? But then, almost overnight, the market crashed and it seemed like we were in a new era and you were back where you were 10 years earlier. Did you ask yourself what went wrong? Where did your money go? Why didn't your financial advisor know what was happening? Was your stockbroker any help? Just as people were about to give up, the proverbial bounce occurred and the market rebounded, heading for new highs. And everyone gave a big sigh of relief and regained their hope and their optimism until September of 2008. And the Great Recession caused the whole market worldwide to drop 50% or more. And you were again left asking yourself, what should I do with my money? Should I buy and hold? Should I tactically allocate? Maybe I should go to cash. Well, should I even be in the market? And more important, how do I prevent these severe losses from happening again to my portfolio? To state the obvious, no one can possibly know the future and tell you with any certainty where you should invest. But the smart people, the ones who actively follow the market and understand how it behaves, have some very good ideas based on sound research dating back many years. Now, I'm not going to say we know the answers, but we do utilize the research and the data developed by 3 Nobel Prize winning economists, Merton Miller, Harry Markowitz, and William Sharpe. This academically sound research in the economic sciences avoids the emotionalism and the fear generally associated with investing. And more important, we can document how this research protected our clients from disaster during the last 10 years. Now, please look closely with me at this chart of the S&P 500. Had you invested in the market in March of 2000, and many people were jumping into the market at that time, you would have invested at exactly the wrong time. You may remember this was the height of the internet boom, March 2000. It turned out to be the top of a very long bull market and one of the worst times ever to invest. The S&P 500, the 500 largest companies in America, a proxy for market performance for decades, experienced a major and lasting shock. And even though most of the disruption was in the tech sector, the general market skidded downward until September of 2003. Let's assume, if you would, that you invested $100,000 in March of 2000. Where would you have been 10 years later, after all the ups and downs? Unfortunately, you'd be about where you were when you started. Had you started in March of 2000, by September of 2002, your account would have hit a low of $61,749. And then you would have recovered. You would have climbed up as high as $128,000 by 2008, only then to be hit with the shock and the disappointment of a falling market, and you would have seen your account tumble to another new low. But remember, markets go up, markets go down. Nothing lasts forever. The market did rebound once again, and most people have recovered back to their original value in 2000. Many of the people tell us that they felt out of control and wondered if they should ever invest in the stock market again. They ask, how come institutional investors fared so much better than the common everyday investor like them? I don't know if you saw this or not, but there was a Dalbar study done for this period of time, and it showed that the average investor earned 3.4% over the 20-year period ending in 2011. Now, during that same time, the market earned an excess of 10% unmanaged. That's a 300% difference. It's no wonder people say they don't know what to do, is it? I mean, how is it institutional investors can protect their assets, make money almost each and every year, and the average investor seems to flounder and lose? Well, let me share why I think this is true. These investors use highly regarded research, most of it backed by those Nobel Prize winning economists, Miller, Markowitz, and Sharpe, that I told you about. Now, I admit, I was just as confused until I learned how to utilize this research. But since 1991, we have consistently applied it to our clients' portfolios, and we've done so ever since. This research is often referred to as modern portfolio theory. It is based on measuring and managing risk. Now, assume the same $100,000 was invested in 2000 in a modern portfolio moderate program. Using this research, it grew to $197,000 by the crash in 2008. And when the markets crashed then, the portfolio did decline, but only to $144,000. And when that bounce occurred, remember, markets go up, markets go down, the rebound since, that portfolio has now grown to $235,000 by January of 2011. Here is what I have learned. Growth is sustained by managing risk. Over an 85-year period, that's 1,020 months, if you missed the 34 best months, you lost 98% of the upside. Miss only 3% of the market, and the growth declines substantially, and you miss all of that upside. What does that tell you? It tells you you have to ride through the bad times to reap the benefits of the rebound. So let me ask you a very pointed question. Do you know how much risk you're taking in your portfolio? Exactly how much volatility are you accepting when the market goes wild and crazy? These are important questions, and if it's left unanswered, the results can cause you a lot of heartburn. Now, this may sound crazy, but the more risk you buy, that's called volatility, the more potential return you'll ultimately expect. And I know it doesn't seem that way, but when the market is down, historically speaking, markets always go back up. It is the nature of the free enterprise system. There will always be declines along the way, but the trend over long periods of time is for an up market. Now you might be saying to yourself, you mean your portfolio beat the S&P 500 by over 100%? How did you do that? Why is there a difference? Well, this series of videos was developed to explain why and how we did that. And when you complete the 3 educational modules I've prepared, you will have a basic understanding of why institutional investors have outperformed individual retail investors by that 300% that Dalbar talked about. Remember, a retail investor is one who buys from the basic name brand broker. And these brokers, they're household names in many places. But these organizations spend a lot of money advertising their brand for one reason: to attract money under management. They do this so they can become well known. But that does not mean they know any more about the markets than other people. It just means they can spend a lot more money making people think so. You see, modern portfolio theory research has been expanded into the 3-factor model. And understanding these 3 factors will help you answer that question that we started with. Why is there a difference? What happened to my money? These educational modules will address the 4 critical factors which affect investment performance over long periods of time. Let me tell you a little bit about each factor. The first one's volatility. Everyone agrees markets go up, markets go down. What they don't know is why. And the key is to learn how to make volatility work in your favor. I call it managing the red zone. The correct asset allocation model dictates your long-run results. Proper diversification works in your favor, not against you. The second factor is portfolio construction. Do you have an efficient diversification, or do you have inefficient diversification? The answer to this will greatly impact your long-term performance. The 3-factor model helps us develop an efficiently diversified portfolio for our clients. The third factor is expenses. What are you paying for sound investment management in your portfolio? There are several studies showing the importance of low cost. And then the final factor, taxes. Taxes that erode your investment results or the cost of your distribution have to do with whether or not you have a lot of turnover in your portfolio. Even though you may have a buy and hold philosophy, you will still pay significant taxes with the wrong strategy. Taxes impact you in a geometric way, so it's important your portfolio be as tax efficient as possible. Each of our educational modules are designed to show you how to manage these foundational factors and how you can then use this knowledge to achieve long-term results similar to the institutional investors. Why should they have all the fun? So, before we move to the first module, let me ask you one final question. Should you review your portfolio? We think it's important for you to get a second opinion. We call this benchmarking your portfolio. That means determine if your investment policy statement's working. Determine how much risk you're buying in your portfolio. And once you know these 2 important factors, you can compare the expected return of your portfolio to a portfolio using modern portfolio theory and our 3-factor model. Because you're watching this module, you are eligible for a no-cost assessment. So just contact us and we'd be glad to do these 4 things. Benchmark your current portfolio, help you measure the amount of risk you're currently buying, determine what your investment policy statement is, whether you have one in writing or not, and then demonstrate the relative relationship between your portfolio and a portfolio designed to optimize the modern portfolio theory elements. It would be our pleasure to help you with this process.